Now let's proceed to the next option, which is the abandonment option. It is the option of stopping a project if operating cash flows turn out to be lower than expected. This option can raise expected profitability and lower project risk. So in short, when the company is suffering the worst case scenario, they may retract or they may withdraw the investment from the project, stopping any further losses. That is why it could raise profitability and it could lower the risk. Now, to compare or to appreciate abandonment option, let's have two projects in which one project is without abandonment option and one project with abandonment option. For this project without abandonment option, we have three scenarios prepared. We have the best scenario, an average scenario, and the worst case scenario. The best scenario has a 25% probability, 50% probability for average, and 25% for worst case scenario. For the best scenario, average scenario, and worst scenario, they have an outflow of 1,000 each. For the best scenario, 400, 600, 800, and 1,300 are its inflow for year 1, year 2, year 3, and year 4 respectively, followed by 200, 400, 500, 600 for average scenario, and negative 280, 280, 280, and negative 280 for worst case scenario. Let's compute for the NPV using the WACC of 10%. And so we have this. So we have 1,348 for the NPV of best case scenario, 298 for the NPV of the average scenario, and worst case scenario has an NPV of negative 1,888. Now we compute its expected NPV. So 1,348 times 25% plus 298 times 50% plus negative 1,888 times 50%, and so we have 14% as our weighted average NPV or expected NPV. Now we compute its standard deviation or its standard dispersion from the mean of the three NPVs given. And so, using your calculator or your Excel, you'll be able to come up with a standard deviation of 1,179. Now let's proceed to the project with abandonment option. So, for best case scenario, average and worst case scenario, both of them has a 1,000 outflow at year 0. And if you've noticed, for the worst case scenario, for the first 2 years, there was a negative cash flow, negative 280 and negative 200. But since the entity has abandonment option, at the end of year 2, they may decide to stop the project by year 3 and year 4. And so they will have no longer cash flow, no positive or no negative cash flow. So let's compute for the NPV using the 10% WACC. So we have 1,348 for the best case scenario. We have 298 for the average case scenario. And we have negative 1,089 for the worst case scenario. If you've noticed, the NPV of the worst case scenario is now lower. Why? Because we have stopped the negative effect of the negative cash flow on the year 3 and year 4. So to get the expected NPV, so the NPV 1,348 times 25%, 298 times 50% probability, and negative 1,089 times 50%. So we have 225%, and so we have 214 expected NPV. Our standard deviation, based on the calculator and using your Excel, our standard deviation would be 866. Now to compare both projects, let's have their summary. Summarize the expected NPV and the standard deviation of the project without option is 14 and 1,179. For the project with option, the expected NPV and standard deviation is 214 and 866. And for us to compare both of them, we need to compute for their coefficient of variation. And so our COV for the project without option is 83.3 and for with option is 4.1. And so therefore, we could assess that the project with option is a better project. So let's now compute for the value of the option, which is just to deduct the NPV or the expected NPV of the project with option and NPV without option. So we have 214 minus 14, and so we have 200 value of the option. Now let's proceed to our last option, and that is your investment timing option. It is an option as to when to begin a project. Often, if a firm can delay a decision, it can increase a project expected NPV. So this one can be compared to a delaying of the investment. This often happens if the entity does not have the full information whether the project or a certain industry in which they wanted to invest their money on is good or not. Now, so again, to assess whether the investment time option is good or not, we will compare two projects, a project with investment timing option and a project without investment timing option. So the project without timing option, so good outcome, we have 50% probability, 3,000 outlay, and 2,000, 2,000, 2,000 cash flow subsequently. For bad, so we have 50% probability, 3,000 outlay, 450, 450, and 450 subsequently. Let's get their weighted average, their NPV using the WACC of 12%. And so, for the good outcome, the NPV is 1804, and for the bad outcome, the NPV is negative 1919. On this case, the expected NPV is negative 58, and the standard deviation is 1861. For the project with time option until we know the market conditions, we have this one. So, on the year 0, since we are not yet sure if the outcome is good or not, therefore there is no investment happening. Now, on year 1, if you see that the market is good, therefore you are now going to invest your money. But if you see that the market is bad, you're not going to invest any money, zero. And so, what will happen? So, with a 3,000 investment for good outcome on year 1, and subsequently it will have a 2,000 inflow for year 2 and year 3. For bad outcome, no outflow, no inflow. And using the 12% WACC, the NPV of the project under good outcome is 339, and for the bad outcome, we have 0. To get the expected NPV, we have 339 times 50% plus 0 times 50%, and we have 170. The standard deviation, we have still at 170 also. So to compare, so the expected NPV is 58, negative 58 for without option and 170 for with option. Standard deviation for without option is 1861 and with option 170. So we compute for their CV, and the CV of without option is negative 32.23 while the project with option is 1. So we know that the project with investment time option, is the better project. Now, let's compute for the value of the option. So let's review the concepts because we might forget it. If the NPV of the project without option is negative, then the value of the option will be equal to the NPV of the project with option right away. But if it's other way around, the above the option will be equal to the NPV of the project with option minus the NPV of the project without option. If you remembered properly, the NPV of the project without option we have on investment timing option has a negative NPV. And so, the value of the option would be 170 right away, which is equal to the expected NPV of the project with option. Now, to furtherly prove it with a computation, we have this one. The NPV considering the option 170. The NPV not considering the option is 0. Why? We all know that the NPV is negative. Further, in our discussion with capital budgeting, we know that if the expected NPV or the NPV of the project is negative, therefore we will not venture into that activity. And so therefore, the NPV is 0. So 170 minus 0, 170, which is the NPV considering the option will be equal to the value of the option.